Everyone thinks $1 million in dividend stocks is the holy grail of retirement. The math says something different. Take $1 million right now, put it in the average dividend fund. You know what you get? About $28,000 a year after taxes. That's $2,300 a month, less than minimum wage in Seattle. But here's what nobody's telling you. The investors who understand dividend math are building income streams that double every 7 years, while everyone else chases yields that barely beat inflation. I'm about to show you exactly what $1 million dividend portfolio actually pays, which ETFs deliver real growth versus dividend traps, and why the highest yields often produce the lowest returns. This is educational content about investment strategies, not personalized financial advice. Always consult professionals for your specific situation. Here's what we're uncovering today. The Dividend ETF that's returned 179% total returns, why monthly dividends change everything psychologically, and the 4-fund strategy that turns static income into growing wealth. Let me tell you about Harry. Harry inherited exactly $1 million from his uncle last year. First thing he did was what everyone does. He searched for the highest dividend yields he could find. His spreadsheet looked beautiful. 4% average yield meant $40,000 a year. $3,300 monthly. Financial freedom, right? Then reality hit. First, taxes. Qualified dividends get taxed at capital gains rates, but that's still 15 to 20% for most people. Harry's $40,000 became $32,000. Then inflation. At 3% annually, his purchasing power drops every single year. That $32,000 feels like $31,000 next year. $28,000 in 3 years. Then the worst part, the opportunity cost. While Harry collected his dividends, the S&P 500 gained 17% last year. His high dividend portfolio? 8%. He made $32,000 in dividends but missed $90,000 in growth. That's the dividend trap nobody explains. Let's start with what most people buy first. VYM, Vanguard High, Dividend Yield Index Fund. VYM holds 583 companies. That's massive diversification. The expense ratio is just 0.06%, basically free. Assets under management hit $79 billion. But here's the number that matters. The yield is only 2.51%. On $1 million, that's $25,000 a year. About $2,000 monthly. Harry's first reaction was disappointment. Why would anyone accept such a low yield? Because VYM isn't really a dividend fund. It's a quality fund that happens to pay dividends. Look at the top holding. Broadcom at 6.84% of the portfolio. This isn't some utility company desperately maintaining its dividend. This is a semiconductor giant growing at 20% annually. JP Morgan Chase at 4.15%. Walmart at 2.15%. These companies could double their dividends tomorrow and barely notice. The proof is in the performance. VYM returned 14.23% total return over the past year. The 5-year total return hit 104.46%. Your $1 million became $2 million while still paying dividends. But the real secret is dividend growth. 14 consecutive years without a cut. Even during COVID, VYM kept paying. Harry put $300,000 into VYM. That generated $7,500 annually. Not exciting at first, but those dividends grew, and the principal appreciated. After 5 years, that $300,000 was worth $600,000, paying $15,000 annually. Double the income, double the principal. That's the VYM strategy. Now let's look at what everyone recommends. DVY, iShares, Select Dividend ETF. DVY yields 3.46%. That's almost a full percentage point higher than VYM. On $1 million, that's $34,600 annually. Harry loved this. Higher yield must mean better investment, right? Dead wrong. DVY holds just 107 companies versus VYM's 583. Less diversification means more risk. The expense ratio is 0.38%. That's 6 times more expensive than VYM. On $1 million, that's $3,800 in annual fees versus $600. But here's the killer: the holdings. Top position, Altria Group at 2.62%, a tobacco company, Ford Motor at 2.36%, an automaker struggling with EVs. These aren't growth stories. They're value traps with dividends. The sector breakdown tells the truth. 26% financials, 25% utilities. These sectors pay high dividends because they can't grow. Look at the performance. DVY returned just 9.68% total over the past year, while VYM delivered 14.23%. Over 5 years, DVY managed 108.85% total return. Sounds good until you realize it started from a lower base and had higher fees. Harry put $100,000 into DVY anyway. He wanted some high-yield exposure. That $100,000 paid $3,460 annually. But the principal barely moved. After 3 years, he still had basically $100,000 paying the same $3,400. The dividend felt good. The stagnation felt terrible. Then Harry discovered SCHD, Schwab U.S. Dividend Equity ETF. This changed everything. SCHD yields 3.76%, higher than DVY's 3.46%, but the expense ratio is just 0.06%, as cheap as Vanguard. The magic is in the methodology. SCHD doesn't just screen for yield, it screens for quality, cash flow, and sustainability. Companies must have 10-year dividend histories, strong fundamentals, growing earnings. The result? You get dividend aristocrats, companies that raise dividends every single year. Look at the holdings. AbbVie at 4.52%, Chevron at 4.41%, Home Depot at 4.28%. These aren't dying companies paying unsustainable yields. They're profit machines sharing wealth with shareholders. 13 consecutive years of dividend growth, not a single cut. The 5-year dividend growth rate averaged 10.87% annually. Think about that. Your yield today is 3.76%. In 5 years, that same investment yields over 6% on your original cost. Harry put $400,000 into SCHD. That's $15,000 annually in dividends today. But with 10.87% dividend growth, that becomes $16,600 next year. $18,500 in year 3, $27,000 in year 7. By year 10, that $400,000 is paying $38,000 annually. The yield on cost nearly tripled, plus the principal grew. SCHD delivered 78.50% total returns over 5 years. That $400,000 became $700,000, while dividends doubled. That's wealth building through dividends. But Harry wanted monthly income. Quarterly dividends meant waiting 3 months between payments. Enter CDL, Victory Shares, U.S. Large. Cap high dividend volatility. Weighted ETF. CDL does something unique. It pays monthly dividends. The yield is 3.25%, not the highest, but respectable. On $1 million, that's $32,500 annually. But here's the psychological difference. Instead of getting $8,125 every quarter, you get $2,700 monthly. It feels like a salary. Harry could budget around it, plan with it. The expense ratio is 0.35%, higher than SCHD or VYM, but reasonable for the monthly convenience. The volatility weighting is brilliant. When stocks get volatile, CDL automatically reduces exposure. When they stabilize, it increases positions. This means CDL falls less in crashes and recovers faster in rallies. 9 consecutive years of dividend growth. The 5-year return hit 101.78%. Your million doubled while paying monthly income. Harry put $200,000 into CDL. That's $540 monthly hitting his account like clockwork. The monthly compound effect was powerful. Instead of waiting quarterly to reinvest, Harry could reinvest monthly. Those extra compound periods added up. After 5 years, that $200,000 was worth $400,000 paying over $1,000 monthly. Let's talk about the total portfolio now. Harry's million was allocated like this. $400,000 in SCHD for dividend growth. $15,000 annual income growing at 10%. $300,000 in VYM for quality and appreciation. $7,500 annual income with market-beating growth. $200,000 in CDL for monthly income. $6,500 annual income paid monthly. $100,000 in DVY for yield. $3,460 annual income. Total annual income, $32,460. Monthly income, $2,705. But here's where strategy matters. Harry didn't need the income immediately. He was still working, so he reinvested everything. Year 1, dividends of $32,000 bought more shares. Those shares paid more dividends. Year 2 income, $35,700. Year 3 income, $39,800. Year 5 income, $49,200. The compound effect was exponential. By year 7, Harry's original million was worth $1.6 million, paying $62,000 annually. By year 10, $2.1 million, paying $88,000 annually, without adding a single dollar, just reinvesting dividends. That's when Harry realized the truth about passive income. The goal isn't to live off dividends immediately, it's to build a dividend machine while you don't need the income. By the time Harry actually retires in 10 years, his million-dollar portfolio will be worth $2.5 million, paying over $100,000 annually. That's $8,300 monthly, forever, growing every year. Here's what most people get wrong about dividend investing. They chase yield instead of total return. They want income today instead of wealth tomorrow. They buy individual stocks instead of diversified ETFs. The math is clear. $1 million at 2.5% yield, growing at 10% annually, beats 4% yield growing at 3%. After 20 years, the lower yield pays double the income. Financial planning isn't about maximum income today. It's about maximum income when you need it. The tax efficiency matters too. Qualified dividends from ETFs get taxed at capital gains rates. That's 0% for income under $44,000, 15% up to $490,000. Compare that to ordinary income taxed at 22 to 37%. The ETF structure also allows tax loss harvesting, selling losers to offset winners. Something you can't do with individual dividend stocks without losing the income stream. Harry learned something else crucial. Sequence of returns, risk. If markets crash early in retirement while you're withdrawing dividends, you might run out of money. But if you reinvest during accumulation years, crashes become opportunities. You're buying more shares at lower prices. That's why the strategy is simple. Accumulation phase. Reinvest everything. Build the machine. Transition phase. Take some dividends. Reinvest others. Retirement phase. Live off dividends. Never touch principal. The $1 million is just the seed. The dividends are water and sunlight. Time is the growing season. Harry's uncle didn't leave him $1 million. He left him a money tree that doubles every 7 years. The difference between Harry and most inheritors? Harry understood compound math. Most people would take that $32,000 annual income and spend it. Cars, vacations, lifestyle inflation. Harry reinvested every quarter, every dividend, every dollar. In 10 years, Harry will retire at 55 with $2.5 million, paying $100,000 annually in growing dividends. His coworkers will work until 67 wondering how Harry did it. The answer isn't complex. 4 ETFs. Automatic reinvestment. Patience. $1 million doesn't make you rich today, but invested properly in dividend growth ETFs, it makes you wealthy tomorrow. The question isn't whether dividends work. They do. The question is whether you'll chase yield or build wealth. Because the investors getting rich from dividends aren't collecting the most today. They're the ones whose income doubles while everyone else's stays flat. That's the $1 million dividend truth nobody tells you, until now.